Kia ora and welcome to this short episode of Shared Lunch, where we look at everyone's favourite subject, interest rates. As you may have heard, the Reserve Bank has decided to cut the official cash rate, the OCR, to 5.25%. Ko Brooke Ho, I'm Brooke Roberts, one of the co-founders and co-CEOs at Sharesies. And to understand the impact of this cut, we're joined by KIwibank Chief Economist Jarrod Kerr. Kia ora, Jarrod. Thanks so much for coming along. As you probably may know, I used to work at KiwiBank, and I've been thinking of you and maybe the pricing committee, which I used to be a part of, where we would get together and talk about what will happen with the OCR and the changes we might make for savers and borrowers. But also, we are both on the NZEIR, the New Zealand Economic Research Institute, shadow board, and we both made the same prediction of what we thought would happen with this OCR. We both, I think, gave it a 60% chance of a cut. And funny enough, the market did too. They also thought there'd be a 60% chance of a reduction, and we have seen that. We've seen the OCR drop by 0.25 to 5.25%. Could you give us a bit of overview of what's happened in the economic environment that's led to this and where we're at with inflation today?
Yeah, thank you for having me on, and it is a lot of fun during these periods when you're involved in pricing committees and the likes. But economically, the country's been in a recession since 2022. Right, we saw that in the bank's data. We've seen it in all the data out over the last year and a half. We will be in a recession for another couple of quarters yet. So the inflation outlook is subdued. We expect inflation to be below 3% in the quarter that we're in now, and back to 2% next year. And as of the latest monetary policy statement from the Reserve Bank, they think the same thing. Finally, they've seen that coming through in their own forecasts. And that means that, job done from the central bank's perspective. They've tamed the inflation beast. It's dropped from 7.3% and it'll be back to 2% pretty quickly. That's great news for the central bank, and it's boosted their confidence, and they've started cutting interest rates.
Yeah, and so we saw the first round of cuts now. This is, I think, the first since March 2020, if I recall correctly. It has felt a lot tougher here in Aotearoa for households and businesses. Do you think this will start correcting that slowdown?
Definitely, absolutely. Households and businesses are doing it tough, and they've been doing it tough for a long time, and they've been waiting patiently for rate cuts to come, and they've come a little earlier than most people and even businesses had expected. So that's good news. But it's not just about the timing; it's about the magnitude. So how many rate cuts are we going to get? And what we've been telling our customers, businesses and households alike is that there's going to be quite a few rate cuts coming. We're expecting the cash rate to fall from 5.5 to 2.5. So with that in mind, businesses are now thinking, well, into next year, the economy is going to improve. 2025 is going to be a much better year than 24, and let's forget about 23. Let's start positioning for some growth, and hopefully they'll start thinking to themselves, let's start positioning for some investment and expansion. And households will similarly be thinking, my budget's going to get a lot better. The pressure's going to be a lot better, and hopefully I'll be spending a bit more next year. So big changes are coming.
So they're saying staying alive to 2025. It's going to be there might be some more continuous drops we might see this year, which will relieve some pressure for those with lending, whether it be businesses or home loans or the like. But you will start to see recovery over time. With people with mortgages, what should they be thinking about at the moment?
I think they've been thinking the right thing. Most people have gone for a 6-month rate, so they have been well aware that the next move's down, not up, and they've been fixing for a very short period of time, sort of 6 months and no more than a year. So I think it's over 70% of mortgage holders have rates fixed for less than a year. That's great because it means they don't have to wait very long to get those rate cuts that are coming through now. And that's important. And it's good news from the central bank's perspective as well, because normally it takes about 18 months. Kiwis tend to sort of love a 2-year rate, but because of all this talk about rate cuts, they've gone to 6 months, which means those rate cuts are going to feed through to households and businesses faster. This is good news.
Yeah, and then what about for house prices? What do you see will happen to house prices here in Aotearoa as rates start to reduce?
So interest rates are one of the biggest influences on house prices. We saw rapid rate cuts during COVID, and that led to house prices taking off, and they rose 45% in 18 months, which was just unsustainable. And then the central bank started hiking quite aggressively to reverse that, and we've seen house prices fall around 20% in parts. Now they're cutting rates again. So they will cut the cash rate as we mentioned before, and that'll start feeding through into the housing market. Looking at the fundamentals of the housing market, there's a massive shortage, and that shortage is getting worse. We're not building enough homes here to keep up with the surge in migration that we've had, so that shortage is getting worse. Investors have been sidelined, they've been targeted, they've been hunted by policymakers with changes to bright line tests and interest deductibility and other bits and pieces. That's reversing, and with interest rates being cut and with rental yields improving, so rents are rising as house prices are going down, all of these things point to investors coming back into the market. As all this plays out, we're expecting house prices to rise by at least 5 to 7% next year, which might not sound like a lot, but it's a big improvement from what we've seen over the last couple of years.
So we may see house prices increase. For savers, they're likely going to get less of an interest rate on the savings accounts or term deposits that'll be coming up. What we typically see on Sharesies when there are lower interest rates is that people do start to move into different riskier assets like investing, where they may believe that they'll get the higher return than lower savings accounts. So it'll be interesting to see that play out over the next year too.
Oh, I was just going to say that's exactly what monetary policy is designed to do. So what you're talking about is exactly what the Reserve Bank relies on. So cutting that cash rate lower and lower, reduces the returns that you get on your simple savings products like a term deposit or having your money in a Sharesies savings account, and it forces people out the risk spectrum to look for high yield elsewhere. So that's exactly what's supposed to happen, and that'll be exactly what they will rely on happening over the next couple of years.
Now, I know you're a very busy man, a very busy economist on a busy day here in Aotearoa. So we'll just leave with one final question, which is could you just give us a key takeaways of the monetary policy statement that was made today, and so that people can go, what are the key things that people should take away from the statement that was made?
I think the key thing is that the inflation beast that we've been trying to tame in recent years has been tamed. Inflation is going back to 2%. We're all more confident in that, which means that the central bank's job is done. So they've lifted interest rates to very restrictive levels. They're now going to take that restrictive interest rate and they're going to put it back to more of a Goldilocks rate, where it's neither hurting nor exciting people. So that's the big move, is that interest rates are falling, and they're falling fast.
Nice. Hey, well, thanks so much for your time today, Jarrod. Really, really appreciate it. I'll let you get back to all the other busy conversations I'm sure you've got lined up today.
Pleasure. Thank you for having me on.
Thanks heaps for tuning in. You can watch this short episode on YouTube or listen in wherever you get your podcasts. Ka kite anō.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest.